Hey everybody, welcome back. Well, the S&P came in pretty hard today. I want to go through a key function here for you to watch tomorrow. This is going to be really important. Then we're going to get into the earnings that happened today, specifically why Apple's up, why Amazon's down, what's going on with Snap, and is Intel going out of business. There's a lot to cover. There's a lot of technical stuff we need to cover so that you're prepped for tomorrow. If you watched yesterday's video, you already had a good grasp on it, but let's get to it. So I have these green arrows here, and I just want to point out what these are. We did this on the public pre-market that we do every morning. I did that. We do that live. It starts at 8. It's supposed to start at 8. And you're more than welcome to tune in, and I always leave those on so that you can just go back and watch them if you can't make it. But this CPI, this right here, this is when CPI came out. We all remember that's when we had the negative CPI data. After that data, what you'll see is that marked the level. Now, why I'm pointing this out is I constantly am talking about the stool. If you're new here, welcome. But what we like to see here is this is the macro leg. This is the fundamental leg. And the way that I look at this, let me just click on this to make my life a little easier. What I like to focus on here is that's how the stool's set up. Then if you come across here, you'll see that sometimes when you have a stool, you're going to lean on this part of the stool. And then other times you're going to lean on that part of the stool, right? So whenever you're sitting on a stool, it's always going to be dependent upon which way you're leaning. And sometimes you're playing the macro game, sometimes it's technical, and sometimes it's fundamental. For example, after hours, there's certain names that are moving, and that is being a fundamental shift, and that is carrying the weight of that particular name. Other times it's an event that happens, and that event is carrying the weight. Other times it's the technical side of the market. What does this mean for you? A couple things. Number one, you need to know these economic data points, and you need to pay attention to them because they are driving the market. And if you're not watching this, and you're just looking at a technical chart, you are so far behind the 8 ball right now, it's not even funny. So CPI set in tone why we had the RSP going up, and we're going to go through that again so that you can see how this is going. Then you would have the Fed meeting, and then you would understand why we saw the Russell completely implode. We can go through that as well, why it happened on that call. What's going on with the Fed market and what the heck happened today? Now, there's a lot of reasons why we dropped today. They're hammering on one particular reason. Do I think it's a be-all, end-all? No. I'm going to pick one of the 3 reasons why this is going on and discuss it because I think that most people will think that that's the most probable. Now, today we had this data point come out. Now, this data point is very, very clear. ISM manufacturing employment, 43.4 to 49. And this is a low number. Yeah, it's a low number. But what this does is it just says, do we have people coming in? Are we hiring? Are we not hiring? Is this number the end of the world? No. A matter of fact, if we start going through some of these other numbers, 47.4, manufacturing PMI 46.8 from 48.8. If you are under 45, just FYI on this number, if you are ever under 45 on this number, let's just go to this real quick so you can remember this. If you take one thing from this video, this is definitely something that you want to pay attention. Whenever you're under this 45, you're cutting. Whenever you're really under that 45, you're getting to that point where you need to cut. It's actually surprising here that they didn't even think about it, but it's very rare to get under 45 on this print. So when you see that, I'll just draw that there so you can see it. It's not normal to have under 45. It's way more abnormal to have under 45 on the Purchasing Managers Index, which is really the thing everybody should have looked at. Matter of fact, if you go back through history, you will see we cut here, cut here, cut here. It's rare. You can really set your watch to under 45. Are they going to cut? So if you take one thing from this Purchasing Managers Index, under 45, they're going to cut. All right. Now, that just on the manufacturing, and if it's the whole, it's just a no-brainer. But so I would take that into account. Now, you'd come here and go, pricing is up, but PMI is down. So you're telling me they could lower pricing and then PMI could go up. Okay. New orders are down, but what everybody focused on is something that nobody cared about until today. Everybody was focused on this ISM employment. And the reason was because it dropped 43.4 from 49, and you were just at 49, and now you're at 43. What's this mean? Well, they're not hiring manufacturing employment right now, and that's how they took it. Now, we have non-farm payrolls tomorrow. We're all aware of that. If we go here for a quick second and just zoom in on that, get to this. I'm going to use this just because it's easier today. But here's non-farm payrolls, 175. You can already see, and I want to point this out, they already knew the number was going to be weak because consensus is what? Negative. They already have a negative number for consensus. So they're already expecting this to be negative. They already have it set up that way. And governments they're not giving a job to, and then you have private non-farm. And let's go through this private number really quickly, because if you go to Wednesday's number, and this is where this is really helpful, ADP comes out with a number. Now, when ADP comes out with their number, they call it the ADP employment change. We were looking for 150. They came in at 122. ADP deals with ADP data. 30 employees or under is their average client. They do payroll. So people would extrapolate that out and they will say, oh, well, based upon that, therefore non-farm payrolls should be down. No, where you should focus on it is on the private side. Just take the private side of that and say, okay, that number's probably going to be weak. Manufacturing's going to be weak. So then that puts us in a position here where we would say that non-farm payrolls is going to be weak. But after all that's said and done, where are we going with this? Let me show you. So here's that 43.4 that is on the ISM employment that everybody is saying this is the reason that we sold. The reason that, in my opinion, why we sold, I'm going to mark it right here so you can say it. Does this have the same effect that I just showed on the other one? No, not even close. Here you are in the 80s hitting that. Here you are in the 90s hitting that. Here you are here hitting it over and over again, 01, 02, 03. And of course, they're going to say, oh, well, we haven't hit it since here. It's hyperbole to get you to stare at something that you really shouldn't be putting that much weight in. I mean, if your prices are up and your new orders are down and you want more new orders, you would drop your prices. It's not rocket science. So to say that this is some misnomer as to why we're selling down, I don't really view it as that. But let's just play devil's advocate and say it is. Some people say the uncertainty with Israel and how that's exacerbating. Some people say it's the political landscape in November and how it's changing back and forth. I don't believe that either. What I think is happening is that people are realizing that this could get worse. Now, here's the thing about it. Could it get worse? Yeah, you have a couple issues here, and a lot of people felt they should have cut rates yesterday, and I do agree with that. Could this be something that you look at that shows that it's worse? Yes. Is this the reason that we sold down? No. Let me show you what's going on under the hood. Now, in yesterday's video, I was really clear on the way that I looked at the world, and hopefully that you found value in that video. We covered a lot of ground in that video, and one of the things that I really wanted to pay attention to, or one of the things I really wanted people to pay attention to, was this Fed tool. And the important thing about this Fed tool is this. I showed the differentiation in timestamp between when he spoke and when he didn't spoke, and I showed the move. So I want to show you what's happened today after everybody reread this and processed all this information. And to think that this happened because of one piece of data is hard. This happened because you have some major shifts going over with Bank of Japan, which we went through 2 days ago and went through that. And it's also happening because the Fed now has decided to not do anything. And a lot of people are looking at this data and felt that they should have. Let's go through this. So this is the current target rate. And we walked through yesterday as well why he has a lot of room to move. And we're going to touch base on this again, why he has a lot of room to move and why is he not moving. But so here we are, and that is our target rate. Right now, we're sitting at 5.3%. But if you look here and you see that number, and they say that this is September 18th, we have a 100% chance right here of easing. There is a 78% chance of one rate cut. There is now a 22% chance of 50 basis points by September 18th. Next, let's walk through this. There is 0.0 chance of anything more. But this is where it gets really interesting. After all the data is looked at, you go from an 88% chance of one rate cut to 78. And then you go from an 11 from yesterday to today, 22. So if you put that in perspective, the chances of 50 basis points today, the chances of 50 basis points has now doubled. And what is scaring people, and you can say, yeah, well, it's new orders. New orders isn't going to do this. It's listening to the call. And the one thing about the call yesterday, his conference call, it was very clear on there. And people that are in the community know this because I got on the call and I said it. He is telling you that they're going to have to cut more than once. Why they're not cutting now or why he didn't cut yesterday, I don't know. Most investment banks are thinking 5 or 6 cuts in a row at this, but it's actually worse than that. And so we're going to talk about it. Here's November 7th. And here you are, 21% chance. So I want to put this in perspective. You're at 5.3 now, and now they're saying this is what you're looking at. They're saying there's a 3.7% chance of only one cut. 2, you have a 73% chance by then, and now you have a 21% chance of 3 cuts by then. So when you start putting that again into perspective, you're currently 0 chance of staying here. You have a 3% chance of only one rate cut by then. 3%, you went from 30 to 3.7% in a day. 62% to 75% chance of 2, and you went from 7.9 to 21%, or you tripled the possibility of 3 rate cuts by November in one day. That's not one piece of data. That's them looking at the entire situation, them being institutions, going through that conference call, sitting down with their economists, coming up with a plan and saying, you know what, this looks like it's going to be worse than we think it is. And therefore, this idea of the soft landing doesn't really look likely. So it's not one piece of data that did it. It's a compilation of pieces of data that has done it. And if you look at December, this is where it gets really, to me, really poignant. So here's the current. By December, there's a 0% chance. And this is, again, I think it's a big deal. There's a 0% chance of only 1 cut. To get to 2 cuts, there's only a 3% chance. 3 cuts, you have a 66% chance of 3 rate cuts right there. And you have a 27% chance of 4. 27% from 7.9 of 4. So that is cut. Then somewhere in here, there's 2 cuts and then another cut. That's the probability of 27.7% chance. If they cut 50 basis points in September or in November, that is not going to look like a soft landing. That's not going to look like, it's going to be that. It's not going to look like a soft landing. So this has everybody nervous, because if we're expecting this and you get this, then that means earnings are going to fall off a cliff. That means that you're going to see claims go up. Now, whether or not that happens or doesn't happen remains to be seen. What you should take from this now is that bad news has become bad news. So if we get a really weak non-farm payrolls tomorrow, then that is going to be construed as bad news, and maybe we're not going to just get 25, that we're going to get 50, and maybe things are even worse than we think they are. You hit this point in cycles like this where bad news is good news and good news is bad news, and then you hit a point where bad news is bad news. I would suggest that we now have flipped, and now bad news is bad news. Now, before we continue, I just want to take a moment. In front of you is non-farm payroll. And so what you want to focus on tomorrow is right around here. Anything under this 133, despite what the estimate is, and I don't know what it's going to be. We never know what it's going to be, quite frankly. And government jobs can have this thing swing around. I mean, when they wanted it lower, they just stopped hiring for a month. And you can go back and look at government payrolls and see that. What you're going to see here, actually, I may show that, but what you're going to see here is you get below this level, like right in here, and you could see some panic selling here. So understand, bad news is bad news. I'm open to your comments on this, but I think we're at that stage, especially after yesterday's comments and what happened with the Fed. And just so you can see what I'm talking about, this is government payrolls, which is part of non-farm payrolls. I might as well just show it. See right in here, they were supposed to have 78, and they just came out and they just did a hiring freeze for a month, and it drops the number down, and then they just go back to hiring. So they can play with it this way by just doing a hiring freeze in the government. I don't think they'd do it this time, but they certainly did it back then to make things look a little bit better. All right, so now you know why you need to be paying attention to these dates and why they're so important, and now you know why you should be paying attention to the stool. Let's clean all this off, and let's start looking at some technicals and get prepped for this, because I think that this is, in my opinion, this is really important. So this is a reversal day, and we can all see that that's a reversal day. You pop up and over like you're going to run, and everybody gets giddy. And then what do? Complete Matumbo. This does a couple things for us, guys. The first thing it does is it lets us know where our major resistance. So it is very clear that this is a control bar and that bar is in control. That's how I view the world, and it works very well for me. What I do is take the high and the low of that bar and everything that trades in it, and that just tells you this is where we changed and that bar is in control. Now you're breaking down a little bit after hours, but this is your range right now and you're breaking out of it. So what you'd want to do is you'd want to watch tomorrow and see what happens. What we'd want to focus on is say, okay, well, where could we get to? So we take this out here on the ES and we would just drop this right here and see you gap fill. So you break that gap fill and it's pretty much on. Now, looking at a 12, let's get rid of this and then let's go here and put on the 22 and comment on this. I'm thinking of changing the colors on this. I'll show you what I'm thinking of doing, making that yellow, because I think you can see it a little clearer as yellow. So, maybe like white, yellow, green, and that might be easier in the eyes. Just comment below. But I was thinking about this because some of you guys watch these on some pretty small monitors. Anyway, you can see that close. Well, right now you're below the 55. I use a 12, a 22, a 55. You should use what you're comfortable with. By the way, you have a 12, 22 cross. You ran right into it here, and then you got completely matumboed. You need to watch this level tomorrow. You need to watch this closely. If we look at some other indicators here, which I think is pertinent right now, if you take a look at what's happening right here, you are below the 50 on RSI, which usually means underperformance. These are things that I will get into greater detail on Saturday's video, but I think you need to be loaded for bear tomorrow. I mean, I think you need to be paying attention there. I think you need to be prepped. I think that this could get really goofy. If I take a look at the Ichimoku indicator, and all I do here is just look at the cloud, and that's what I'm just going to show you, the cloud right now. Once you get in here, it gets like Wix. So what's happening right now is that it's setting up for us to get in here, and that this is going to start getting mushy. Right? That's the technical term, mushy. So if you start looking here on NQ, you're already what? If you can't lift through this and you get on the other side, can you say underperformance? Okay, you can just say it with me, underperformance. This is where you underperformed, right? Even though it looked like it was going to start turning until you pop out of it. So you have to keep that in mind with all your trades. Doesn't matter the trade, it gets really hard in here until it's not, and then life gets a little easier. It's just the way that it works. You can overlay it yourself and say it, and that leads you towards the RTY, and everyone will say, I'm not buying RTY because it went down for one day. Even though if you look at RTY, okay, you're below the 12, the 55's right there. And what you would actually look at is take, from my perspective, is go, okay, well, what index is actually above, your 55 right now? And so you start going through them and going, well, the ES looks like it's going to crack. The NQ has cracked. Okay, so you have the RTY. So what do? You go look at the diamonds. Okay, well, the diamonds are holding, but for how long, right? So this is where your head has to be. Where I think that it makes the most sense to look, and where I started shifting was I just started shifting into some names like MO. These kinds of names that are just interest rate sensitive names are going to benefit greatly from this. If you start looking at stuff like TLT, these names are just going to benefit greatly from what's going on. That's what moves right now, and that's what I'd be paying attention to. This is where the money will flow. It's just the way that it is. I would not rule out, candidly, I mean, maybe they're going to sell off because the market is, but I would not rule out financials. I certainly wouldn't rule out the idea that regional banks are going to have an issue. People will say, oh, well, the consumer is not their problem. Their problem is commercial real estate. Commercial real estate, even if that pulls back, that's something you should look at, but you can see how that's lifting. Why? Because they're going to go after yield. If everything gets weaker, then what's going to happen to these kinds of names, the VNOs of the world? They're going to get better rates. It's just the way it is. So they're all levered, and that leverage will help them. Some other people will sit there and go, oh, I want to look at the Utes. Yeah, the Utes can absolutely break out here. That can continue as well. And you can always look at things like UTSL, and you can see how that did exceptionally well today. My problem with this stuff is it works until it doesn't work, and so that's what you have to watch. Do I really want to be buying breakouts on a 3X bull ETF ahead of non-farm payrolls, and then it comes in hot, and then I'm looking at like 29.80 and wondering what I'm supposed to do with it? So you might want to watch this tomorrow and then see how it plays out before that. But you want to look at interest rate sensitive ideas. In regards to some of the tech names and what you're seeing going on out there, it is very difficult to look at the stocks right now and say everything's fine. Far from it. When you start to break down like this, that's pretty much it. You have a 12, a 22, and a 55. You're below all of them. How I look at this is this. This is the 12. I don't swing trade these unless I'm above it. If I can pick something off, I will. I had a really nice trade here the other day where we bought NVIDIA actually down here. I showed it yesterday, and then it went up here. We trimmed 3-4 times. That's it. It's a wrap. I still have a portion on because I'm still up in the trade despite everything happened. But you have to trim into these. My rule of thumb is this, guys, and I'll get more into it there. But if you look at this, I'll show you something. And it's been something I've used for years, and it's been very, very helpful. I'm going to get into it more on Saturday and how you can use these kinds of tools to just kind of give you something objective. Because people want to guess, and guessing is going to get you the results of a guesser. What you want to do is not be like the 96% of the people that don't make money day trading. You want to be like the 4 that do. That comes from being objective. Once I break a 55 on this relative, that's pretty much it. My breaks will go on for tech swing trades. And you can even just go and take a look at that from like March 11th on to you got here and just go see. It's the relativism of it. It's not absolute. It's not looking at the Qs or the SPY. Once I do this, I just stay out of the way until it goes there. Now, will I trade? 100%. I was even long names today and actually did okay. See, the way to trade in this kind of environment, your tools have to change. And what you have to think of your tools, besides like when you look at something like you take a look at your stool from the standpoint of like the macro, okay? There are times to use pullback tools, right? If you were building a house, sometimes you need a drywall, sometimes you need an electrician. I don't care if you think this is a rant or not. It's going to help somebody. What you have to focus on is when you're supposed to use certain things. So let me give you an example of this. And I do think that this is worth your time. And I do think that I don't have live on this, but I have live on something else that I think is worth your time. So here's what I would show you, and I find this extreme. If you look at the Qs, now some people say RSI doesn't work, and here's what I would say to them. RSI may not work for your style of trading, but that doesn't mean that it doesn't work. For example, if you're selling zero-dated options and you're using RSI, it's not going to work for your style of trade. If you're trying to pick a bottom in an index sector or stock and you're not using negative divergences and positive divergences, you're at a huge disadvantage to somebody like me, period. It's just a fact. You can see them all the time. And once you see them, you can't really unsee them. I mean, you could actually even see, if you're looking at this right here, you can even see right here, and you can see the negative divergence from here on the chart. You can see it here as well. Doesn't matter, but here's what I did today, and this is what's important. People in the room were saying, well, how did you know that the market bottomed? And here's the thing, okay, great. You have this area in here, but how do you know that that's stopping? All I'm looking for is something like this, because we'd say, well, the gap fill did it. Well, okay, well, when? When did the gap fill do it? Because if you're buying options, and you're buying zero-dated options in here, well, you're bleeding out, right? I'm not bleeding out. Why? Because I know that this is a positive divergence and I know what the trigger is. And so what I'm doing is I'm waiting for that. And I'll give you an example of this. So here is that making a lower low. And here's an example of this making a higher high. Now, this was a tough day today. And the other thing I want to say while I'm thinking about it, if you struggled today, don't go and reinvent your process, guys. These are anomaly days where you're down 4 or 5%. If you go and change your process around these days, that's the issue. The issue with most people today is if they just honored their process, they would have been right. That's usually the issue. But what I did was I wanted to spec it. So I put a speculative trade on at the end of the day to see if I could take advantage of it. And so what I did was I bought calls 60 cents and the spec options on the 460s, no stop, they're 60 cents. It is what it is. It's either going to work or it's not. They're, what we refer to them as heroes and zeros. Then what happened is this. Now, and this is actually, I should cover this too, but these are other trades we did. But as they're going up, I'm pulling money out the whole time. And Apple was back to break even. We had a day trade on it. Then Microsoft popped. We had a day trade on that too. But here's the thing about these day trades. I did these trades, like I did the Microsoft trade twice. It worked once. Once it didn't work. I still made a little money, not a lot. Apple worked once towards the end of the day, and I did okay with it. Not everything you're going to do is going to work in this environment. To look at something like Apple and think that you're going to catch the downtrend, you're betting against the trend, right? So when you're betting against the trend, and if you look at the trend like a river, do you want to swim upstream or downstream? Downstream, right? You want whatever the trend is, just swim with it. But when you're trying to get ahead of these things and you're trying to catch them, and this is really important to get, yeah, you can see a bounce. You didn't have that bounce today because you had too much selling. Now, this is a really important concept, and I can show you how to start identifying trends. If that's interesting to do a video like that, let me know, and I'll start working on identifying trends, how to do it, how you can tell when the counter trend's there and when the trend's there. Just comment below. It might not be the best topic. People might find it somewhat boring compared to the other stuff, but I think it's helpful. But comment below on that, and we'll go from there. Also, I'm thinking of doing a live Q&A, which I think would be a great thing to do, maybe on a weekend or something. So if you took a look at Apple after hours, we should go through some of these numbers. I don't think that this was, anything that should be down. I thought this was a really good quarter. We're going to go through a bunch of these names so that you're prepped for tomorrow. I just think that this was a good quarter. I think they said all the right things, and I think it was solid. Does it go up tomorrow? I don't know how much weight we have on us. I really don't. Melly absolutely crushed. And this is what you want to see, breakouts like this. Are they going to hold? Are they not going to hold? Yeah, we're going to have to see if that does or not. I thought some of these quarters, I thought some of these quarters were great. I thought Square was excellent. I thought it was an absolute excellent quarter. There wasn't much to say about it. The chart looks god awful, but overall, I thought it was a really solid quarter. Intel is a dumpster fire floating down the river with a bunch of raccoons. Actually, it's actually an insult to a dumpster river floating down the river with a bunch of raccoons. Suspend the dividend, and we're firing 15% of the staff, but don't worry, we're going to keep our salaries right where they are. So in other words, what they're doing is just bleeding the company from every orifice right now. I think you're down what? Absolute huge mess, huge revenue mess. Took in money. No one knows really where it went. It didn't go to the dividend. It didn't go to keeping the employees. So what does this mean? It means you got a problem. It's probably going to be a teenager. I think you're going to $17, $18. Maybe it goes back to 16, not even able to drive again. So, it's just, that's it. It's the death knell. When you suspend the dividend, to quote, save cash. What are you saving it for? What are you saving the cash for, right? Like, I mean, think about it. If you think about it from that perspective, what are you saving it for? You're saving it for your salary, right? That's all you're doing. That's really all you're doing at this point. You're not saving it to, what are you building? Nothing. You're building nothing. So you're going to see this is just going to get absolutely smoked. I'd watch that level tomorrow. If you can bounce to that, you might want to pay attention to it. In regards to Amazon, just disclosure, I'm short Amazon at the time of recording this. And I actually think that this was really not anywhere near as great as people think it was. I think the larger issue with Amazon is that you're going to be related to the consumer, and that's bad. You can't really miss revenues, even though this is pretty much a flea on a gnat for them. I mean, you're doing $1.48, $1.50. It's a lot of money to say, oh, we're off by 40 basis points, especially when you're beating. And the cloud business was good, and the spending's there. I just think that right now it's just too much. So where does that really put us when we go and take a look at this tomorrow? What area has to hold? You're pretty much through everything, guys. So it's really going to be on non-farm payrolls. But if I had to give you a drop dead level, you're looking at that 166.22. That's it.